Hey guys, it's Ray Campbell. It is Friday, August 18th. We are going to take a part of Robin Hood Men in Tights here, and we're gonna try something. The part where he says, "Maybe if you give me the bad news in a good way, it won't sound so bad." So here we go. So good news for you is interest rates are up. There's a lot of talk about mortgage rates possibly hitting 8% as a national average. This is great news for pretty much nobody, but you know, it is what it is, and we have to just kind of deal with it as we go. So hope that makes your Friday great and you get to have a great weekend knowing that interest rates are higher for you. So yeah, I'm not sure that really is going to help the situation, but that's kind of where we're at, guys. So interest rates are up. You know, I know that everybody's been talking about interest rates coming down, and there was a lot of speculation as far as when that was going to happen. We had specific dates that we were looking at. Inflation reports were going to be coming in a certain level and help interest rates come down, and so on. And so, you know, everybody essentially missed the mark on the timing of all of this. And that's what we're looking at, is the timing. So interest rates are up, sure, but why? The biggest thing is that, as far as I can tell, is I think, you know, investors and traders are really more focused in realizing that we are, in fact, a world economy, right? Like it hit us real hard in 2008 when everything started going sideways, and then the whole world was like, oh, wow, like this is collapsing, then that is tied to that, and that's tied to this, and so on. And so I think we're seeing quite a bit of that, where, you know, I see a lot of reports and news reports and articles that are coming out about another country having some sort of inflation problem, or devaluing their currency, or, you know, just different things like that are coming out. And I'm kind of noticing a little bit of a trend with the news that's coming out of the rest of the world isn't quite matching the United States, right? Like we had all of the reports showing the economy is slowing, not as much as they want, but it's slowing. The inflation is coming down, not as much as they want or as fast as they want, but it is coming down. It's all working in our favor, and that should be good news to help mortgage rates and long-term rates come down. But they're not. The reason that they're not, well, I think that's tied to a number of things, but you know, the world has some things going on in different countries that affects us. I know it doesn't make a whole lot of sense, but you know, other countries invest in the United States, and the people in the United States invest in other countries. So when there's inflationary issues and there's different things happening with money, with the dollar, value of the dollar here or there, talk about, you know, the OPEC, you know, using a different currency instead of the dollar, like things like that have an impact on what happens here. And I think that's part of what we're seeing, but also fear. I've mentioned it before. The fear, investors and bond traders, and they're just not sure where the top of this thing is and where it's going to stop and turn around. And so they don't want to get in early. They don't want to lose money early. And so they don't want to jump in just yet. Plus, on the short end, you know, 2 years, 3 years, or 6 months, even 6 month treasuries are paying. You can get a 4 to 5% or so return in a matter of a few months, kind of a situation on some short term treasuries, instead of putting that money into 30 years or 20 years, right? And so that money is moving out of long term into short term. That's the whole point of the inverted yield curve. When that starts to, you know, compress, I mentioned it before, that money is going to start moving out of the short term into the long term. That's going to bring interest rates down. You know, the yield curve is going to start to fix itself, and then interest rates are going to come down even more. So when is this going to happen? Couldn't tell you. You know, it looks like it should be starting to turn, depending on a number of factors. You know, here, maybe it happens in September, beginning part of September, when the Fed comes out and makes their next decision on if they're pausing on raising rates or not. But remember, when they raise rates, that's supposed to bring down inflation, and inflation coming down helps interest rates come down. That's what it's supposed to do. Hasn't been doing that because of a lot of different reasons, but in September, that decision is going to come out. We'll have to see if this is going to be the turning point. It looks like that could be it. This could be, the next couple of weeks could be the turning point. We could see where we're at the top now. Yeah, I know an 8% national average interest rate kind of scares everybody. I get it. It's a little bit on the high end. You know, I wouldn't even say the interest rates are high if they were 7, because 7 is just the high end of normal. But eight's a little high. Okay. In fact, today we're at highest point for yields and treasuries since 2007. So I get it. It's been 20 years and this is where we're at, right? So a little high, a little painful. We have to help people understand where we're at, the benefits of taking the short-term pain, taking that interest rate that's a little bit high on the payment to get in now rather than paying $50, $75, or $100,000 on the home in 6 months, 12 months, or a year. Past that, it just, 2 years, whatever that time frame looks like, the housing prices are not coming down. There's not enough demand. There's not enough supply to let that happen. Okay, so the interest rates, unless they go to like 12 or 13%, which is kind of crazy, but I don't believe that that's going to happen. But that would be really the only thing that's going to slow housing down enough and make people not buy to bring home prices down. They're just not going to come down, guys. So they're going to pay more for the house over time. It's going to be so much more expensive than taking a year, 18 months higher on the interest rate and then looking at the refinance down the road. No guarantees that that's actually going to happen, of course, but that everything points to that. Whether that happens in 6 months, 12 months, 2 years, not entirely sure. It's looking more on the short end than the long end, but we have to understand this market has to figure itself out. This is kind of one of those new normal kind of situations. They got to see where inflation is going to settle, and then they will jump back in and we'll find our top end for interest rates and we will start to come down. Like I said, just the yield curve itself fixing itself, right, and going back the other way should bring interest rates down from where they are. So lots of things that can happen to bring interest rates down, and that will happen. We're just trying to find the bottom, trying to figure where everything's at, and there's some uncertainty. Not everybody is convinced that we are there yet, and because of that, there's some people waiting on the sidelines. Some people are in, like, this is it. Some people are like, nope, this isn't it. And then there's people in the middle, and when the people are saying this isn't it, they don't want to get in, or they sell off because they're not thinking that it is. The people in the middle have to make a decision, and they're either going to wait or they're going to get out too. So a lot of it is, well, let's just get out right now. So lots of selling, liquidity issues, which cause those moves to be more exaggerated than they really should be. So we just got to hang on for a little while, guys. This will work itself out. It's not the end of the world. Be creative, have conversations, guys. Use numbers and facts, and make sure they're facts, not just articles. Okay, right? Lots of news articles you could throw out to people that are only half truths, or maybe the headline's true, but the article just doesn't really support what it's saying. Lots of different things that need to be clarified. So make sure you're using facts, numbers, and putting that information in front of your clients so that they understand what's really truly happening and what those numbers look like, so that they can make an informed decision. So as always, I hope you guys have a great weekend. If you need anything, give us a call, send us a text, whatever. We'll be happy to answer your questions, help you out over the weekend if you need something. And if you want to have a further conversation with us as well, always give me a call. You can reach us on our team numbers, 214-441-7496. Hope you guys have a great one, and we will talk to you again next week. Bye.